billionaires and future millionaires. I'm Lane Bean, a 28-year retired lieutenant colonel and former F-16 pilot. In the last 20 years, I side hustled and bootstrapped one single family house into a multi-million-dollar apartment portfolio. I'm a 1991 graduate from the U.S. Air Force Academy and a magna cum laude graduate from the College of Hard Knocks, Experience, and Real Estate Investing. I'm here today to help you become a better real estate investor by teaching you what I learned over that period so that you can become a better millionaire. Today, we're continuing the video series to help educate and train you for what I believe is a fantastic buying opportunity on the near horizon. The next couple of minutes, I'm delighted to share with you a good friend of mine and a guest that works in the real estate marketing research industry and across the nation, across the continent. He's spoken at numerous conventions and at numerous conferences. His expertise is recognized by many people and leaned upon, certainly by me. We speak often about real estate trends, marketing, and he's one of my top go-to guys to get the very best information. And he has volunteered selfishly his time and knowledge and experience to come and speak with me and speak with you for this reason. Listen carefully. Like I mentioned, we have an up and coming opportunity to buy at a very good price, but we're going to need expert opinions on what the market is doing, what the potential property, what the economy will do, and he is the expert to go to. So let me introduce to you Chris Nebenzahl. He is an investor himself, and I've already described a little bit about his background. So Chris, thank you for visiting with us today. I'm going to put it over to you, and would you fill in any of the biographical information that I didn't already add? Over to you, Chris.
Great. Well, thanks, Lane. And Lane, thank you for the opportunity to be on your program today, especially in these interesting and trying times. There's a lot for us to focus on and a lot for us to think about in the real estate community and in the community at large. As you said, my name is Chris Nebenzahl. I'm a real estate researcher as well as a real estate investor. I've been investing in real estate, single and multifamily houses for about 10 years now. And so I've seen certainly the rise of this cycle, but also now the cycle coming to an end and what we're going to expect to see coming out of this downturn and into the next expansion cycle. As you mentioned, I'm a researcher, and I also focus a lot not only on the real estate, but demographics, economics, and the social aspects behind the value of commercial real estate. What's driving people to move market to market? What's driving jobs to expand and contract in certain areas? And I think that's going to be really a key for us to focus on thinking about real estate, thinking about multifamily perhaps specifically, but what's going to be the drivers behind both the markets and the submarkets, and then the types of properties that will be most advantageous coming out of this oncoming recession that we expect to see.
Right on, Chris. So let me ask you this kind of overall question first, because I feel like that there's going to be an approaching buyer's market or a good opportunity maybe to buy some assets in multifamily is what I'm speaking of in the near future. We don't really know when that near begins, maybe in a couple of weeks, maybe months, or maybe a little bit extended past that point. Do you think that there is a good buying opportunity approaching as a result of this unfortunate global pandemic?
I do. I think there has to be. A couple months ago, as you mentioned, when I was speaking at some of the conferences that I attend on a regular basis, I would have said that the next recession would have been incredibly small compared to the 2008 financial crisis. Today, in hindsight, we obviously see this recession as potentially bigger. We've seen more fiscal and monetary stimulus than we did in 2008. We've seen greater economic impacts across industries, not just finance, not just housing, but the restaurant industry, the airline industry, the oil and gas industry, all taking pretty hard hits. So I do expect there to be a correction in real estate prices, specifically multifamily. I think the key to how great the correction will be, and perhaps to the timing that you were asking about, is will be seen in the next couple of weeks. April is the first real month where rent collection might be an issue. We're now on the 6th of April. Usually late payments are due by the 7th, 8th, 9th of the month. We've seen organizations like the National Multifamily Housing Council extend their recommendations for no late payments, no foreclosures. And that's really a necessary step right now to backstop those who've lost their jobs, those who can't afford to pay rent. The trickle-down effect, though, is what does that do to the owners? If there's less revenue coming in, how can they handle their cash flow issues? Perhaps they're looking for forbearance in terms of making their mortgage payment. Can they pay the bank what their monthly mortgage is? So a lot of the banks and Fannie Mae, Freddie Mac, the agency lenders are allowing some forbearance. So there's a lot of flexibility right now, specifically in the multifamily market. On the rent side, on the consumer side, all the way up to the investor side. The question will be how long that flexibility remains, and tie that back to when do we reach a peak of this virus? When do we really start to recover from both a global health perspective as well as an economic perspective?
So let me see if I understood you correctly, Chris, is you do feel like there's going to be a good buying opportunity. It's still a little bit too early to evaluate when that window opens, but it'll be the timing and the length and the severity of it will be based on several variables that you mentioned: small business getting back on their feet, financing markets, and then just the general economic recovery is going to define that window opening, how long it's open, and how quickly it opens, and then how quickly it closes potentially.
Yes.
That's a good. Super, Chris. Sorry I cut you off. So let me ask you this question, Chris, because it's in line with what you just answered there. What do you feel like would be some of the major triggers or points that would be the litmus test of a returning economy or a reviverance of, going forward? What point do we start investing again, and what are the triggers for that, indicators?
Yeah, so the first thing I think we need to identify and we need to watch for is the flattening of the curve. And by no means am I a medical professional, but we've all heard on the news this concept of flattening the curve. That's why we're social distancing. That's why we're taking extreme measures of shutting down restaurants and bars and movie theaters and sporting events and concerts. So we need to see the trajectory of the caseload and of the hospitalizations start to slow down and start to flatten out. That's what you've seen in China over the past about a month. That's what you're starting to see in parts of Europe. And even in some hard hit places like New York, Seattle, Washington, you're starting to see the caseload start to slow down. Now it's still growing, but the rate of increase is starting to slow. And that's what they mean by flattening the curve. And that's the first step towards kind of overcoming the medical issues with the virus. Now, as soon as we're able to do that, or not perhaps as soon, but shortly thereafter, I expect you'll see some of these social distancing regulations and restrictions start to lift. So we'll be able to go back to restaurants and bars. Now, some of the bigger events, sporting events, concerts, major conferences, that might take a little bit longer to recover, just because of the nature of how you need to schedule those well ahead of time. But certainly the local economies can start coming back relatively quickly. We talked a little bit about the stimulus package. Thus far, it's been a very generous stimulus package. not only are small businesses getting some of the stimulus money, but unemployment claims and unemployment benefits, I should say, are increasing significantly. So the cash coming into households should be able to bolster us at least for the coming months. Whether you're still employed, recently become unemployed, there should be some cash buffer there that, again, if we're able to get the health crisis under control, the economy should be able to bounce back relatively quickly. And that's when you'll start to see more of kind of the economic growth turnaround.
So, Chris, you mentioned the very first thing that has to happen is the virus has to find a plateauing or just has to stop, increasing, I guess, in size. And I think that is the number one. That's really what got us here, right? That's what put the brakes on the economy, not the economy. It was the virus and the health requirements. So that's number one. Number two, as you said, they have to have the social distancing and the governors or the limitations on business lifted, removed, or modified so that people can get back to work. And then the last one was the results of the stimulus package and how that will empower small businesses or business owners to regroup, put their staffing back on the payroll or keep them on the payroll. So let me ask you a specific question about that, because I believe that that's the right answer too. And I do think those things obviously have to happen before the investor confidence or before it makes sense really to reinvest in multifamily. What are the metrics that we can use as investors to measure specifically the stimulus package? Like, are you going to be looking at unemployment numbers and seeing those flatten out? Are you going to be looking at the stock market to evaluate investor confidence? Are you going to be looking at, jobless claims? What are some of the metrics? Because Chris, again, this is for the audience. Chris has got a encyclopedia, a library of data that you couldn't even imagine, right? He's got that at his fingertips, and he looks at this all the time. So, Chris, what can we do, maybe from a layman's research point of view to evaluate some of these statistics, and when we see them turn around, that may be an indicator? How would you comment on that?
Certainly. And the key metric that I'm watching now and have been watching for the past 2 weeks are the initial jobless claims, as you mentioned, Lane. Through most of the past 8 or 10 years, jobless claims on a weekly basis hovered around 200,000 to 300,000. That's new people each week filing for unemployment insurance. 2 weeks ago, that spiked to 3.3 million, tenfold increase from the prior week and the normal rate of unemployment claims over the past 10 years. Last week, it spiked again to 6.6 million. So that in 2 weeks, 9.9 million people filed for unemployment insurance. Just for a little perspective, in the great financial crisis, we lost about 20 million jobs over the whole recession. I'm sorry, not 20 million jobs. We lost about 8 million jobs. Let me rephrase. Of the whole recession, we lost 10 million jobs last week,
right?
And in the 2 weeks prior. So we're going to see a significant ramp up, and I expect when the claims come out this week on Thursday, we'll see another couple million unemployment claims. As soon as those level out and then decline. So we had talked about the virus cases kind of cresting. We want to see the unemployment claims decline, because that's going to signify that not only are fewer people applying for these claims, but they're also starting to go back to work. And so the restaurants are opening again, the bars are opening again, the shops are opening again, the theaters, et cetera. So the claims backed up by the stimulus and the CARES Act, which I think initially allocated about $350 billion for small business payrolls. I expect that to be expanded. I think many small businesses will be taking advantage of that benefit. And Treasury Secretary Mnuchin has already said if that $350 billion runs out, he expects to go back to Congress and have even more stimulus for small businesses approved. So between that and then the additional benefits for unemployment insurance, I expect to see the consumer and the individual be able to weather this. And so as soon as we start to see those claims decline, hiring pick up. So hiring is a little bit more difficult because it's only on a monthly basis. So we'll see that with a lot more of a lag time, a slower recovery, and we won't be able to act quite as quickly. But those claims that come out on a weekly basis is something I'm watching quite closely. You asked about the stock market as well. One thing I would mention about the stock market is that it seems now like it's more driven off of news and less off of fundamentals. You see rumors, not even the official passing of the stimulus package, but rumors of what the stimulus package would include, and the stock market jumped. I think the stock market actually declined on the day that the Senate approved and the president signed the stimulus package. So there's more trading and more transaction being done based on news. Did caseloads jump overnight for the virus? Did they recede overnight? Is there good news coming out of China? Is there good news coming out of Europe? Or vice versa? Is there bad news coming out of Asia and Europe? So the stock market, while it is an indicator of expected future cash flow, it's trading less on the fundamentals of each of the companies that make up the Dow Jones or the S&P, and more on speculative news about what future demand might look like, which at this point, again, we're still at the early phases, I believe, early to mid phases of what this virus and what this recession is going to look like. I think we're trading much less on knowledge and data and more on speculation.
So Chris, let me ask you a real quick follow-up question there, because you said something that that I think was very good. Is you said that we have already seen this unemployment number spike, which we expected because the businesses all got shut down, right? That's going to happen. And then you continue that and you said the hiring is going to be a slower or a lagging metric. Is there any specific metric like the unemployment statistics that you can look at and say, hey, this is what I'm using to judge hiring? Or is it just is the unemployment claim your number to judge hiring?
Yeah, so the unemployment claim is more focused on those who are losing their jobs, being furloughed, being laid off. The hiring story, I think, is going to be an interesting one, Lane. The longer that this issue continues, the more people will be hesitant to hire, to get back into the stock market, to get back into the real estate market. People are going to be a little bit conservative coming out of this, especially if it continues through April, through May, through June, into the summer. So the hiring might not be, I would almost guarantee it won't be as quick as the layoffs came. But what we do want to focus on is what's going on from consumer sentiment. That's one of the metrics that's reported monthly. And that's a pretty good judge of what's happening across the consumer base. The consumer makes up about 70% of GDP. So if the consumer is confident and the consumer is spending, it's pretty likely that GDP will follow. But for the consumer to spend, you need those restaurants, those bars, those shops to be open, not just the grocery stores. The grocery stores are going to be fine. People are going to continue shopping at the grocery stores, but more of the discretionary purchases, to some extent the luxury goods. Automobile sales is actually another one that I would focus on. Again, there is some lag with automobile sales, but once we see automobile sales come back, that means that, okay, the consumer is once again confident in their own financial position. They're able to buy that new car or get that second car or third car, whatever it might be. So that's another indicator that I would look probably towards the end of the summer. I don't expect there to be much activity for the next couple of months, but that would be a good leading indicator as well.
So for the job loss, you're looking specifically at unemployment claims and unemployment filings. For the job hiring because like you mentioned as one of your requisites, you said small business owners, small business employees have to come back to work and they have to get back on the payroll. That's what I would coin hiring. And then
Yep.
the metrics to measure that are really more subjective. They're kind of a compensation of our collection aggregate of several different, metrics, but it's a little bit more difficult to gauge. Is that accurate?
Yeah, it's a little bit more difficult, and it's a little bit longer. So
Yeah.
the Bureau of Labor Statistics on a monthly basis posts their new job creation report. So that's
Okay.
certainly something to keep an eye on, but it does lag. So it's reported on the first Friday of the month for the previous month, and then revised a couple of times. So again, I expect once the virus kind of curbs, let's say May or June, July, whenever it might be, that you won't see the data for the hiring come back for another 6 weeks, perhaps 8 weeks after that.
Got it. All right, Chris, let's dig down. We talked, that's kind of the broad national landscape. Let's talk a little bit more about some of the markets. Do you think that there is going to be any stigma associated with the coronavirus, so that now maybe some of these urban centers that were hit really hard will be less attractive investments, and some of the areas that were not as affected, will they become more attractive? Will the outerlying areas, that are in the suburbs or rural areas, because they can social distance, are those going to have an additional value going forward that'll stick more so than an urban area that was, densely packed? What is your thoughts on that?
Yeah, this is a tough question, Lane, and I'll try to break it down into a couple parts. Because you're right, the densely populated urban areas have been some of the hardest hit. You look at Seattle, Washington, you look at New York. These are also some of the most diversified economies. Certainly New York, a financial capital, a media capital for the whole world. And so I don't think New York will necessarily disappear, go away. But you're right, the congestion and also the infrastructure. I'm sure you've heard of the temporary hospitals being set up in parts of New York City. New York has one of the strongest medical infrastructure systems in the world, and yet their healthcare system has already been overwhelmed. So I do think you'll see an overall continued transition and continued migration. You and I have been talking about this for years long before coronavirus became an issue, but the overall migration pattern has been out of the Northeast, out of California, out of specific areas in the Midwest like Chicago, where whether it's the tax system, the infrastructure, the job growth, not to say that there hasn't been job growth in those markets, but the rate of growth has been much faster in places like Austin, Texas, Charlotte, Raleigh, Durham, Nashville, Denver, Phoenix, Las Vegas. Some of these markets, again, like Phoenix and Vegas, because of their dependence on leisure and hospitality, they will also get hit hard. But I would look at some of the markets, what I would consider a secondary tech market, like in Austin, like a Raleigh, like a Denver, to grow faster coming out of this. They haven't been hit quite as hard. Certainly there's health concern. I'm here in Denver, Colorado. I know, Lane, you're in Texas. We've both been talking about the regulations and the social distancing in our local communities. So not to say that these markets aren't taking this issue seriously, but they haven't been hit quite as hard. And I think they've got the economic diversity and the economic infrastructure to recover on a much quicker basis than markets like a New York that has just so much of a virus concentration, or places perhaps like Las Vegas or Orlando, which is starting to see some economic diversity, but are still so heavily dependent on an industry like leisure and hospitality.
So it sounds like, Chris, that these markets that you mentioned, the Southwest, the Southeast, these were developing economic areas, and there was already a good market, strong market there for real estate investing. But now, from what we know, and again, this is early in this COVID crisis, I don't see really any negative impedance or any stigma associated with Corona that would dampen out that desire to continue to move here. There may be some fallout from New York City because of the hot spot there, or maybe California, but that's really kind of to be determined. But there's certainly not any negative pressure like on Dallas or Texas or Colorado or North or South Carolina, because they kind of didn't get hit as hard yet. Hopefully they won't. And maybe that social distancing, the more spread, not as density of population, may even make it more attractive. So I think that's a good takeaway. Chris, let me ask you this question. Go ahead.
I think we've taken really drastic measures, but the smart measures, the right measures. And I think whether this was a conscious decision or a subconscious decision, the leaders, governors, mayors, up to the federal level, have said, look, we're going to risk a very, very significant economic recession in the short term in hopes of recovering from this relatively quickly. And when I say relatively quickly, I mean on the large scale. The grand scale of a couple months is relatively quick, so that we don't go into a 3, 4, 5-year recession where we try to keep certain engines of the economy open, only to find out that the virus is actually spreading and shocking the healthcare system even more so than it has. And then the recession expands into a number of years.
Right on. Okay, so far we've talked about the triggers that have to change before we have a buying opportunity. Then we talked about those specific metrics that we'll use to measure each one of those data points. We just finished talking about the market. So now let's get real into the weeds there and talk about the assets. Okay, so now, we've talked a lot and shared a strategy on how to, how to buy an asset or whatnot, look at a property. So let me ask you this question, Chris. Do you see across and I'm talking multifamily real estate investments here, the different asset classes, different age properties, different size properties, properties that cater to, very high income individuals, and in other properties that may be low income opportunities? Do you see an equal opportunity across all of those different size, quality, cost points, or will there be one specific asset class that you feel like is more valued because of the COVID crisis?
Again, I think that really comes back to how long this issue remains. Certainly with the stimulus package, it was geared towards service sector employees who lost their jobs. It was geared towards anyone who lost their jobs, but what we've seen is that the service sector has laid off the most workers in the immediate past 2 to 3 weeks. Most of those employees tend to live in a Class B or Class C asset. So perhaps they lost their job, but they're also being backstopped by the government stimulus. For the most part, we've seen the technology sector, the financial sector, the real estate sector, the information sector. Those jobs are the most able to work remotely. So those tenants are likely working from home, likely they still have an income and they're still able to pay rent. So right now, between the stimulus and those who still have jobs, we're in a pretty comfortable position from a liquidity and a cash perspective on the consumer side, on the renter side. What I think will be very interesting is if the hiring doesn't return until September, October, December, God forbid, into next year, then the stimulus and the liquidity that the government's providing will likely run out at the end of July, August, September, perhaps if there's a second bill passed. But if the stimulus doesn't equate to the economic needs of the B and C class renter, I think you'll see a lot of move outs, and I think you'll see occupancy fall precipitously in those asset classes. I think the A asset class is somewhat insulated, again, because the majority of those residents are able to work from home, are able to have a little bit more discretionary income, and can probably handle a little bit longer of a recession. Now, I do think this recession will impact people across industries, across pay levels, but I think it will have a greater impact on the B and C class renter. Finally, I think that you will have a lot of difficulty leasing up new builds. So I know a lot of the new builds this cycle have been in the A class, and I just said the A class is a little bit more insulated. But if I could caveat that a little bit by saying fully stabilized A class properties are likely the most insulated. I don't think there will be a lot of people moving, both moving in or moving out, unless economic situations become incredibly dire, where you see people move out, move in with family, move in with friends, double up. But I think the lease up periods for new product, and again, most of that product is Class A, I think that will be lengthened, and I think that'll be harder for those new properties to lease up.
So, Chris, that's great advice there. So it sounds to me like they're in the B and C class stabilized. They're probably going to be impacted more than A class if this is of a duration maybe to last through the summer. If it lasts longer, everybody will be impacted. So that's a different adjustment, perhaps. And then the A class opportunity may be one that is in the midst of lease up, or that may have some other type of financial cliff that it really can't extend its operation or exit point. It has to do that. So that's good. Okay, let me ask you this last question, Chris, and then we'll wrap it up. Okay, but this is going to be the big one. All right.
All
right. So get ready. We're going to go in and we're going to buy these new assets or whatever A class, B class, C class. We may be taking a new market look and all of these things. So now, since there's really been a market reset point, a price reset, if you will, because of this declining revenue, there may be even some geographic adjustments, because now this urban area is no longer as attractive as the suburban area. There's not really going to be a good precedence. There's not going to be any recent sales for the last 3 to 4 months. The financing requirements are going to be different. And so how do we determine if I'm going to pay $1 million, is that a good price? Because that price, if I was to look at it post-COVID-19 and compare it to pre-COVID-19 numbers, those evaluations, is that even a good comparison, or are we in a different evaluation method, a different pricing method, a different market condition? Obviously. So I'm kind of leading up to this question. My question is, Chris, how do we determine the price? And is this a good price or is this a bad price? What's some of the things you'd use to suggest we buy or don't buy?
Yeah, Lane, and that's the $1 million, $1 billion question right there, isn't it? I don't have a crystal ball, and I wish I did, to see 6 months, a year from now, what valuations would look like. But I think what you'll start to see investors focus on is the cash flow and the in-place revenue that they can derive on an immediate basis. Again, I think if you're a current owner, working with your bank and working with your lender, there will be some flexibility and some forbearance of your mortgage. But I don't think those banks will be as flexible if you're an investor going in to buy a new project. Because right now we might not know exactly what the risks are, but we know that there's risk out there. So the lenders probably won't be willing to say in 9 months, oh, you bought this at the end of 2020, we'll give you some flexibility because there was an issue around coronavirus. No. We know what's going on right now. So I think a lot of investors will focus on cash flow. How is the property performing at the date they're looking at it? They'll likely have somewhat smaller expectations for rent growth in the first 2 years, perhaps, But again, it goes back to the fundamentals of how is that market, how is that submarket, how is that property, and will that area continue to grow long term? So again, thinking of markets that have seen pretty steady growth in this, excuse me, not this recovery. I have to change my mental state because I've been saying this recovery for so long. In the past cycle, in the past recovery, what markets were doing the best, what markets were growing the fastest, and do those markets have the same likelihood to continue growth going forward? I think it's very interesting, and we were somewhat fortunate, or I should say secondary market investors were fortunate. The last recovery was so long. It allowed places like Denver, like Dallas, like Austin to really grow and become globally recognized markets. And just look at the number of international flights out of those airports. It's not just LA, San Francisco, New York, Boston anymore. So again, if those markets, if we are able to slide through this issue relatively quickly, and again, I want to stress that relative quickness, a couple months, perhaps the end of the summer, then I think those markets will be able to come back. But investors, getting back to your question, I think investors will be focused initially on cash flow, on what that property is producing today, and then they'll think long term on the likelihood for growth. But the immediate valuation, the immediate pricing, I think will be based on cash flow.
Chris, that's excellent. I really enjoyed the way you said that. And the reason that I said that is because it's the resistance of an investor like myself. I'm a private investor just like you are. And do I want to put my money into this property? And when do I put it in there? And so really the question is, what is the trigger to buy? What is the value to purchase this property? And you eloquently wrapped up that trigger point. And let me see if I captured this correctly, is the current pricing and evaluation model may not be relevant in post-COVID-19, depending on the economic input. So then we're not really talking about cap rates or speculation or value add, because that really may not be foundationally solidified at the point we're trying to buy. But what you did say was you're looking at current in place cash flow and asking yourself, at this cash flow point, can I sustain the property? Because for the first 1 or 2 years, it's unlikely that we're going to see this pre-COVID-19 yields, because a pre-COVID-19 may, this time last year, I may have been enticing or attracting you for a 7 or 8% cash on cash yield. And you said, that's a good investment for me, or maybe it is, maybe it's not. But post COVID-19, the first 1 or 2 years of yield may be thin, and it may not meet the same qualifications. It doesn't necessarily mean that's not a good investment, but it's just different. And that's because we've had that price reset, and we're going to have more than likely some type of low rent growth as we clear this. And even though it's behind us, there's not going to be that momentum that we had. So I'm going to make sure that I made a note of that. I hope our audience also heard that, and they can use that as a trigger point to say, hey, this is going forward where I may put my price and offer a price, knowing that first year yield may be a little bit suspect, and follow on the price and cap points may not really be pre-COVID-19. Is that accurate to say? That was a long wrap up to your question, but is that accurate?
Yeah, it is. I think, like you said, the first year, perhaps the first 18 months, maybe there will be less payout to investors. Maybe the cash payouts will be slimmer, like you said. Thinking about
but we're capturing that in value because we're hopefully getting a better value and a discount on the price. And maybe, like I said, the IRR will be very attractive. The yields may not be as attractive. And then the equity multiple, again, we're buying this at a good discount. So we're looking at those metrics across those three different types of metrics.
Yep.
Well, Chris, I think that fundamentally says that, boy, data today and research in the markets as they change so rapidly is critical. That is your superpower. That is your ninja trick. You are a real estate and research ninja, and you're a Superman. If the audience wants to connect with you, or do you provide those services? Do you give advice, or can you consult with them on any specific market across the country? And what would that look like? And how do they get a hold of you if they needed to talk or they wanted to speak some more specific details about this?
Absolutely. Thanks, Lane. And yeah, anyone, please feel free to reach out to me. Reach out to Lane. He has my contact information. I can give you my phone number here. It's 339-364-1895. And I'm happy to talk about markets, submarkets. It's what I do. Like I said, not only do I look at the real estate, but I look at the demographics, the economics of what's happening. And I love talking about markets. So Lane, thank you very much for having me on the program. This is what I do on a regular basis, and this is what I really love to do. So please reach out. Any questions, I'm happy to continue the conversation.
It's been a delight, Chris, as it always is. And I just want to summarize the action steps that our listeners and our audience and our investors can take. Because like I mentioned already, we are doing things now. We're preparing, we're training, we're educating ourselves on the risks that are approaching, on the investment opportunities, because we don't yet know when those are, but we know they're approaching. And that's why we're taking the time today to learn, to educate, to identify these milestones, if you will, so that the passing of each milestone, we get closer to that point where we invest and we eliminate the risk. We stabilize our confidence so that when Lane calls you or you call Lane and say, hey, this is what we've been talking about. This is what we've been training for. It's now time to deploy on the mission. It's now time to execute. We will be able to do that. And like I said, you are becoming an educated investor, a wise financier, and you're going to become a better millionaire. I thank you for listening today, and I'm looking forward to helping you reach your financial goals. Thank you.